In 1694, a group of London merchants gathered in a counting house to sign papers. The documents bore no grand seals of state. No royal trumpets announced the occasion. The men involved wore the plain coats of traders, not the robes of kings. They handed over $1.2 million in gold and silver to a government at war. In exchange, they received a charter. The transaction took less than 2 weeks to complete. 3 centuries later, every economy on Earth runs on a system born from those papers. The Standard story presents the Bank of England as an innovation in monetary policy. Textbooks describe it as a rational solution to currency problems. Economic historians frame it as the natural evolution of financial markets. They point to Amsterdam's Whistle Bank, to the goldsmiths of Lombard Street, to the slow professionalization of credit. The documents tell a different story. The Bank of England was not created to manage money. It was created to fund a war against France. The 1694 charter reads, not as a banking constitution, but as a loan agreement. William III needed cash to fight Louis XIV. His treasury had run dry. Parliament refused to raise more taxes. The king faced a choice between losing his throne or finding a new source of funds. Enter William Paterson, a Scottish merchant with a simple proposition. A group of private investors would lend the government $1.2 million at 8% interest. In return, the government would grant them a monopoly on specific banking activities in England, and the investors would form a corporation. The corporation would issue notes against the debt the government owed them. The government gained immediate war funding without raising taxes. The investors gained a permanent income stream backed by the English state. The public gained paper money they believed was backed by gold. Everyone gained something, except the future, because embedded in those founding documents was a structural incentive pushing toward perpetual government debt. The bank's profits depended on government borrowing. The government's military capacity depended on bank lending. Each party needed the other to survive. Each party benefited when the other grew larger. This was not banking. This was the invention of a financial machinery designed to extract wealth from future generations and concentrate it in the hands of present lenders. The Bank of England did not serve the economy. It captured the state's borrowing capacity and built infrastructure around the permanent flow of interest payments from taxpayers to bondholders. The men who opposed the charter in 1694 understood this. Parliamentary records show members warning about perpetual debt and endless obligation. They saw the bottleneck being created. They named the gatekeepers being installed. They predicted the leverage being handed to private financiers over public spending. Their warnings went unheeded. The war needed funding. The funding needed a bank. The bank needed a charter. The machinery started turning. Welcome to Rashii Historical. We follow the money, trace the power, and expose the history they never taught you in school. You carry a wallet. Inside it sits paper currency, or a plastic card linked to digits on a screen. Those digits exist because a central bank created them. The central bank in your country operates on principles established in 1694 London. When your government borrows money, it borrows from institutions modeled on the Bank of England. When your central bank buys government bonds, it performs operations first pioneered in William Paterson's counting house. The interest you pay on your mortgage flows through channels dug 3 centuries ago. The inflation eroding your savings follows patterns established when those first Bank of England notes entered circulation. The debates about central bank independence you hear on the news replay arguments first made in the English Parliament of 1694. You live inside a financial architecture designed to fund an 18th century war against France. The architects have been dead for 300 years. The architecture remains standing, and it grows larger every year. This is the story of how it was built. William of Orange arrived in England in 1688 with a Dutch army and a Protestant claim to the throne. His wife Mary held the bloodline. William held the military force. Together, they displaced James II in what English historians politely term the Glorious Revolution. The revolution was glorious for William. It was expensive for England. James II did not accept his displacement quietly. He fled to France, where Louis XIV gave him shelter, recognition, and an army. The deposed king became a permanent threat across the English Channel, backed by the wealthiest and most populous kingdom in Europe. William had to fight. Fighting required money. William had very little. The English Treasury in 1689 operated on medieval principles. The Crown possessed certain revenues from customs duties, land rents, and specific taxes Parliament approved for limited purposes. The system assumed peacetime expenditure. It provided no mechanism for sudden massive military spending. William needed ships. He needed soldiers. He needed gunpowder, cannons, uniforms, food, and transport. The 9 Years' War against France would become the most expensive conflict England had ever fought. Between 1689 and 1697, military spending consumed over 70% of all government revenue. The king tried taxation first. Parliament granted new duties on alcohol, salt, and imported goods. These raised significant sums, but never enough. The gap between revenue and expenditure grew wider each year. William tried borrowing. The Treasury issued short-term notes promising repayment from future tax receipts. Investors bought these notes at steep discounts, demanding high interest to compensate for the risk the government might default. Each loan cost more than the last. By 1693, the government paid interest rates exceeding 14% on some obligations. The debt accumulated. The interest payments consumed increasing portions of available revenue. Each new borrowing made the next borrowing more expensive. The system spiraled toward collapse. France watched and waited. Louis XIV understood finance. He knew William's treasury could not sustain the war indefinitely. Time favored the Sun King. He had the larger economy, the larger population, the larger tax base. He could simply outlast England's capacity to borrow. William needed a breakthrough. He needed a source of funds outside the normal channels of taxation and short-term lending. He needed permanent capital committed for the long term at affordable interest rates. He needed what William Paterson was selling. William Paterson remains an enigmatic figure in financial history. Born around 1658 in Scotland, he spent his early adulthood in the Caribbean and the American colonies, working as a merchant and possibly as something more ambiguous. Records from this period are sparse. Paterson kept his early biography deliberately vague. By the early 1690s, he had established himself in London as a projector, the 17th century term for a promoter of commercial schemes. Paterson proposed ventures in Scotland, the West Indies, and Central America. Some of his ideas were brilliant, some were disastrous. His later Darien scheme would bankrupt Scotland and kill thousands of colonists. In 1691, Paterson began circulating a proposal for a new type of financial institution. He called it a fund of perpetual interest. The proposal documents, preserved in fragments and later reconstructions, outlined a simple mechanism. A group of investors would pool their capital and lend it to the government. The government would pay annual interest on the loan in perpetuity. It would never repay the principal. The investors would form a corporation to manage their collective interest. The corporation would have the right to issue notes against the debt owed to it. The government gained immediate access to large capital sums. The investors gained a permanent, guaranteed income stream. The corporation gained the ability to create money. Paterson understood the third element was the true source of profit. If the government owed you $1.2 million and paid reliable interest, you held an asset worth at least $1.2 million. You could issue notes against this asset. People would accept those notes as money because they represented a claim on government payments. You could lend these notes out at interest. You could expand your balance sheet far beyond your original capital. The government's debt became the foundation for private money creation. Paterson shopped his proposal to various government officials between 1691 and 1693. He found interest, but also resistance. The goldsmiths of Lombard Street, who performed banking functions for wealthy clients, opposed any chartered competition. The Tories in Parliament suspected the scheme would permanently entangle government finance with private interests. The Treasury doubted whether investors would commit such large sums. The war changed the calculation. By 1694, William III's financial position had deteriorated beyond normal remedies. The government needed $1.2 million immediately. Traditional borrowing at acceptable rates was impossible. The Treasury turned to Paterson's proposal as a desperate measure. Charles Montague, the Chancellor of the Exchequer, became the political sponsor. Montague understood money. He had already reformed the English coinage and would later help establish the gold standard. He saw in Paterson's scheme a way to create permanent government financing capacity while distributing the political risk across private investors. Montague packaged the bank proposal within a broader revenue bill. This procedural move limited parliamentary debate and prevented the scheme from receiving the scrutiny it deserved. The Tonnage Act of 1694 buried the Bank of England's charter within legislation about shipping duties. The bill passed in April 1694. The bank opened for subscriptions in June. The Bank of England. Charter of 1694 runs to several thousand words of dense legal English. The document establishes the corporation, names the initial subscribers, grants specific privileges, and imposes certain restrictions. Reading it carefully reveals the true nature of the institution being created. The charter begins with a preamble explaining the purpose. The government needs money for carrying on the war against France. The subscribers offer to lend $1.2 million. The government agrees to pay 8% annual interest plus $4,000 per year for management expenses. The total annual payment comes to $100,000, funded by new duties on shipping tonnage and alcohol. Note the structure. The bank's income derives entirely from government payments. The government's payments derive entirely from specific taxes. The bank exists as an intermediary between taxpayers and subscribers. It performs no productive function. It simply channels money from one group to another, taking a management fee along the way. The charter then grants the subscribers the right to incorporate as the governor and company of the Bank of England. The corporation receives a legal personality separate from its members. It holds property, enters contracts, and sues in its own name. This corporate form protects individual subscribers from liability beyond their investment. The critical clauses appear in the middle sections. The bank receives the exclusive right to operate as a joint stock banking company in England. No other corporation can compete with it for the next 11 years. Individual goldsmiths and private bankers may continue their business, but they have no ability to pool capital on the scale the bank commands. The charter grants the bank permission to deal in bills of exchange, gold, silver, and bullion. It allows the bank to take deposits and make loans. Most importantly, it permits the bank to issue notes. The note-issuing power created money from nothing. When the bank lent money, it did not physically transfer gold coins. It issued notes promising to pay gold on demand. These notes circulated as currency. Merchants accepted them in trade. Taxpayers used them to pay duties. The notes became money through common acceptance, not through gold backing. The bank's total note issue soon exceeded its gold reserves by large margins. This worked as long as not everyone demanded gold simultaneously. The bank made profits on the spread between what it paid depositors and what it charged borrowers. Its notes multiplied the money supply without any corresponding increase in precious metals. The charter established governance structures weighted toward large investors. The court of directors consisted of wealthy merchants who held substantial bank stock. Voting rights scaled with shareholding. The institution would serve the interests of its major investors, not the interests of the general public or the government. One clause attracted particular attention in Parliament. The charter prohibited the bank from lending to the Crown without parliamentary approval. This restriction appeared to limit bank power. In practice, it meant something different. It meant Parliament would regularly vote on renewing the bank's lending authority. Each renewal provided an opportunity to negotiate terms. The bank gained a permanent seat at the political table. The original charter ran for 11 years, expiring in 1705. Everyone involved understood it would be renewed. The government had no other source of large-scale, long-term financing. The bank had no other customer worth its attention. The marriage was permanent from the first day. Chapter 4. The Voices of Warning. The Tonnage Act passed the House of Commons, but it did not pass without opposition. The parliamentary debates of 1694 preserve arguments against the bank scheme expressing concerns more relevant today than they were 3 centuries ago. Tory members voiced the primary objections. They represented landed interests, the traditional English gentry whose wealth came from agriculture rather than commerce. They distrusted the rising power of London merchants and financiers. They saw the bank as a mechanism for transferring influence from the countryside to the city. Sir John Knight, member for Bristol, warned about perpetual debt. If the government never repaid the principal, Knight argued, the obligation would compound across generations. Future taxpayers would pay interest on debts incurred before their birth. The original lenders would extract wealth indefinitely. The arrangement benefited the present at the expense of the future. Knight's analysis was precisely correct. The national debt of England in 1694 stood at approximately 1 million by 1700. After the bank's operations began, it had grown to 12.8 million. By 1720, it exceeded 50 million. By 1750, it topped $75 million. The debt never shrank. It only grew. The bank's structural incentives guaranteed this outcome. Other members worried about monopoly. The charter granted exclusive joint stock banking privileges. Private competitors had no ability to organize on comparable scale. The bank would dominate London finance through legal protection, not through superior service. Robert Harley, who would later become Chancellor of the Exchequer himself, objected to the speed of the proceedings. The bank proposal received minimal debate. Burying it within a tonnage bill prevented focused examination. Harley accused Montagu of manipulation. The most prescient objections concerned political influence. If the government depended on the bank for financing, and the bank depended on government payments for income, the two institutions would merge their interests. The bank's directors would gain influence over government policy. Government ministers would gain influence over bank lending. The arrangement created conflicts of interest across the entire political system. Critics called this corruption. They meant the term precisely. A corrupt system is one where private interests distort public decision-making. The bank created permanent private interests in government debt. The larger the debt grew, the more money the bank made. The bank's directors would support policies increasing government borrowing. They would oppose policies reducing it. War meant borrowing. Borrowing meant profits. The bank had a financial interest in military conflict. This objection appeared extreme in 1694. The bank's supporters dismissed it as paranoid speculation. The next 3 centuries would prove the critics correct. England fought more wars after 1694 than before. Each war increased the national debt. Each debt increase expanded bank power. The machinery operated exactly as the opponents predicted. Parliament passed the bill anyway. The war required funding. The funding required the bank. Theoretical objections yielded to practical necessity. The Bank of England opened for business on July 27, 1694. Within 12 days, so the entire $1.2 million subscription had been collected. Investors ranged from wealthy merchants to minor gentry to a few aristocrats. The subscriber list reveals the social composition of English capital at the end of the 17th century. The Court of Directors held its first meeting in August. The minutes from these early sessions, preserved in the Bank of England archives, show an institution finding its footing. The directors debated where to locate their offices. They hired clerks and accountants. They established procedures for receiving deposits and issuing notes. The first operational challenge was mechanical. How do you lend $1.2 million to a government at war? The bank did not physically transfer gold and silver to the Treasury. Such a transfer would merely swap one form of money for another. Instead, the bank credited the government's account with $1.2 million in banknotes. The government spent these notes on war supplies. Contractors who received the notes could deposit them at the bank or exchange them for gold. The notes entered circulation as money. The government's debt became the foundation for the entire system. This arrangement reveals the true nature of money creation in a central banking system. Money does not originate from gold mines or mint operations. Money originates from lending. When the bank lent to the government, it created money simultaneously. The loan and the money were the same thing. viewed from different perspectives. The Court of Directors minutes from 1694 or 1700 document the expansion of bank operations. The institution began accepting deposits from private customers. It made loans to merchants against commercial bills. It dealt in foreign exchange. Each new activity generated profits. Each profit attracted more shareholders. The bank's relationship with the Treasury deepened quickly. By 1697, the government owed the bank $3.8 million. The original $1.2 million had grown through additional loans during the war's final years. Each loan increased the bank's leverage over government policy. The bank also began managing the mechanical operations of government finance. It handled the payment of military salaries and pensions. It administered the lottery loans that supplemented direct borrowing. It processed customs revenues. The institution became embedded in daily government operations. This administrative role proved as important as the lending function. Once the government depended on the bank for routine financial management, switching to alternative arrangements became prohibitively difficult. The bank created path dependencies that locked in its position. Crises tested the new system quickly. In 1696, a silver shortage triggered a run on the bank. Depositors demanded gold for their notes faster than the bank could supply it. The bank suspended gold payments temporarily. It survived through a combination of luck, government support, and public confidence manipulation. The survival mattered. It demonstrated that a paper money system backed by government debt could withstand shocks. The bank was not as solid as gold, but it was solid enough. Chapter 6. The Template for the World. The Bank of England's 1694 charter established patterns that would replicate across the globe. Every central bank operating today contains DNA from William Paterson's original design. The specific features vary. The fundamental structure remains constant. The first replication appeared in Scotland. The Bank of Scotland received its charter in 1695, explicitly modeled on the English institution. It lent to the Scottish government, issued notes, and competed with the Bank of England for commercial business. The Scottish experiment confirmed that the English model could be transplanted. France followed in 1716 with the Banque Générale, later the Banque Royale. John Law, a Scottish financier who had studied the Bank of England closely, designed the French institution. Law took the model further than Paterson had imagined, expanding note issue until the system collapsed in 1720. The failure taught future central bankers about limits, but did not discredit the underlying concept. The American colonies developed banking more slowly. After independence, Alexander Hamilton studied the Bank of England intensively before proposing the first Bank of the United States in 1790. Hamilton's institution copied the English template precisely. It lent to the federal government, issued notes, and enjoyed a monopoly on federal deposits. Hamilton read Paterson's original prospectus. He understood the structural incentives. The United States abolished its central bank twice, in 1811 and 1836. Both abolitions proved temporary. The pressure to concentrate banking power and create government financing capacity reasserted itself each time. The Federal Reserve, established in 1913, represents the third American attempt at central banking. Its structure descends directly from the 1694 template. Germany, Japan, China, Brazil, India, and every other major economy eventually adopted central banks modeled on the Bank of England. The International Monetary Fund and World Bank, created in 1944, spread the model to developing nations as a condition of membership in the global financial system. By 2000, no significant economy lacked a central bank. The template includes consistent features across all implementations. Central banks lend to governments, they issue currency, they hold monopoly or near monopoly positions in their national financial systems. They maintain close relationships with Treasury departments. They create money through lending rather than through commodity backing. The structural incentives remain identical to those in the 1694 charter. Central banks profit when government debt expands. Governments gain spending capacity when central banks lend. The arrangement favors present consumption over future prosperity. It favors borrowing over saving. It favors inflation over price stability. Every generation since 1694 has paid interest on debts incurred before their birth. Every generation has seen prices rise faster than wages. Every generation has found it harder to save, harder to buy property, harder to achieve financial independence. These outcomes flow directly from the system's design. The men who drafted the 1694 charter did not intend these consequences. They wanted to fund a war against France. They wanted profitable investments for their capital. They wanted stability for their commercial enterprises. The long-term effects of their creation exceeded anything they imagined. But the consequences were predictable. The opponents in Parliament predicted them. The perpetual debt they warned about has perpetually grown. The political corruption they feared has thoroughly materialized. The transfer of power from taxpayers to bondholders has continued for 3 centuries. You live inside the system. Your currency derives from central bank operations. Your government's borrowing shapes your economic prospects. Your savings lose value through inflation engineered by monetary policy. Your children will inherit debts you never voted to incur. The Bank of England's Charter of 1694 was not a banking document. It was a political constitution. It established relationships between money, debt, and power that have outlasted every government that signed it. The original borrowers are long dead. The original lenders are long dead. The debt remains. The interest payments continue. The war against France ended in 1697. The Bank of England never ended. Its charter has been renewed continuously for 330 years. The institution evolved, expanded, and consolidated power through every crisis. It survived the South Sea Bubble, the Napoleonic Wars, both world wars, and the 2008 financial collapse. It nationalized in 1946, but continued operating on identical principles. The bank today holds assets exceeding $1 trillion. Its interest rate decisions affect every mortgage, every business loan, every pension fund in Britain. Its quantitative easing programs have purchased hundreds of billions in government bonds. The founding mechanism persists. The government borrows. The bank lends. The public pays. William Paterson died in 1719, having lost most of his fortune in the Darien disaster. Charles Montague, elevated to Lord Halifax, served in various government positions until his death in 1715. William III died in 1702, his French War concluded, but his financial innovation just beginning its long career. None of them witnessed what their creation would become. None of them saw central banks spanning the globe. None of them imagined a world where every transaction, every price, every economic decision would pass through systems they designed in a London counting house. The documents from 1694 sit in archives. Scholars examine them occasionally. The handwriting is faded. The paper is yellowed. The ideas have conquered the world. You did not choose this system. You were born into it. Your parents were born into it. Your grandparents and great-grandparents were born into it. The architecture was completed before any living person drew breath. Understanding where it came from represents the first step toward understanding where you are. The Bank of England's 1694 creation was not inevitable. It was a choice made by specific people for specific reasons at a specific moment. Different choices remained possible. Different structures could have been built. They were not built. This structure was built, and you live within its walls. The money in your pocket carries the weight of 330 years of accumulated decisions. The prices you pay reflect 3 centuries of inflation. The debts your government owes trace back to a loan made to fight Louis XIV. The interest payments continue. Welcome to the system William Paterson designed. You have been inside it your entire life. Now you know how the doors were hung.